April 2026 became the ultimate stress test for crypto. On one side, a DeFi security crisis that rattled the industry. But on the other, institutional Bitcoin stood its ground, proving a resilience we haven't seen in previous cycles. It all started with Kelp DAO, a sophisticated bridge exploit that drained nearly $300 million in minutes. This wasn't just a simple bug, it was a targeted strike on a fundamental piece of cross-chain architecture. Kelp DAO relied on a one-of-one verifier setup, a non-standard configuration that left the door wide open. Hackers compromised two specific RPC nodes, injecting forged messages to trick the verifier into releasing funds. Simultaneously, a massive DDoS attack forced the system into a failover, ensuring the poisoned nodes were the only source of truth. 116,000 hours.We were drained. The attackers took 18% of the total supply in a single flash. Security analysts have already linked this level of sophistication to state-sponsored actors like the Lazarus Group. Their strategy was unique. Instead of selling and inducing slippage, they turned the stolen assets into collateral. This is where the contagion began. Because hours.We was integrated into the entire DeFi stack, the breach went systemic. Aave was hit the hardest. The attacker used the unbacked hours.We to borrow real assets, creating a bad debt crisis. In DeFi, everything is interconnected. When one money Lego breaks, the entire structure starts to wobble. Over $170 million in bad debt was created. This was the black swan event of the year. $10 billion in total value locked evaporated in just 48 hours as users fled to safety. But while DeFi burned, Bitcoin told a different story. For the first time, we saw a true institutional decoupling. Bitcoin didn't just survive the volatility. It broke through a 7-month bear flag to hit new multi-month highs. Surging past $75,000, BTC proved that institutional appetite is now a permanent market floor. The driver behind this move? Relentless ETF inflows. Despite the DeFi chaos, the money didn't stop flowing in. Cumulative net inflows into US spot Bitcoin ETFs crossed $56 billion by mid-April. BlackRock's IBIT continues to lead the pack, absorbing supply faster than miners can produce it. Currently, ETF demand is absorbing over 1.2 times the newly mined Bitcoin supply every single day. We are now feeling the full weight of the April 2024 halving. The reduced supply is hitting the market price with a lag. Each cycle is maturing. From 6.25 to 3.125, the scarcity is becoming undeniable. As we approach the midpoint of this epoch, the digital gold narrative has moved from theory to corporate policy. Companies like MicroStrategy now hold more Bitcoin than some of the world's largest investment funds. Volatility has dropped significantly. Bitcoin is no longer just a speculative asset. It's a high beta institutional staple. We are already looking ahead to 2028. The next halving is only 100,000 blocks away. While the gains might be more measured, the stability is attracting a different class of investor. Central banks are watching. But back in the DeFi trenches, the recovery will be slow. The Kelp DAO exploit has changed the rules of the game. The lesson of April 2026 is clear. Modular security is only as strong as its weakest verifier. Protocols are already moving away from single point of failure bridge setups toward decentralized quorums. Aave's umbrella protocol is now the industry standard for bad debt protection, but the risk remains real. Institutions aren't leaving DeFi, but they are demanding higher security standards and better audits. We now live in a two-speed crypto economy. One side is fast, innovative, and risky. The other is stable, institutional, and growing. Bitcoin has cemented its place as the digital gold pillar of the modern financial portfolio. As we look to the rest of 2026, the question isn't whether crypto will survive, but which parts will lead. The divergence between Ethereum-based DeFi and Bitcoin is the defining trend of this decade. Trust is being rebuilt, but it's being built on the foundation of institutional-grade security. For the individual investor, the message is simple. Stay vigilant in DeFi, but stay patient in Bitcoin. The Kelp DAO exploit was a wake-up call. The Bitcoin breakout was a confirmation. Both are part of the same story. The future of money is being written right now. block by block, exploit by exploit, breakout by breakout. I'm your reporter for the digital age. Stay tuned as we continue to track the evolution of global finance. Thank you for watching.